6 months ago, I did something a little bit crazy. I took 20 of the biggest SaaS stocks on the market and I sorted every single one of them into one of 4 buckets based on how they'd hold up when things got hard. Not on hype, not on price target, on durability. Well, it's been 6 months since I did that. The market's up about 13%, and today we find out how each one of those 4 buckets actually did. Some of them crushed it. One of them lost to the market. And at the end of this video, I'm going to show you 3 stocks that I'm moving to a brand new bucket. And some of those moves might surprise you. So stick around and let's get into it. Now, let's set the table here because the question I was asking back in February was simple. Which of these businesses survives the SaaS-pocalypse? Remember, this is when Anthropic started coming out with tools like Claude Cowork that were directly attacking enterprise software. And if AI eats software the way that everyone said it would back then, I wanted to know which of these companies actually make it out the other side. And I used 4 tests to determine which 4 buckets these stocks will go in. Now remember, at the end, stick around because I'm going to be moving 3 of these stocks to a brand new bucket, and at least one of them might surprise you. So the 4 tests that I use. Test number 1, deterministic versus probabilistic. So does the software have to be right every time? That's deterministic. And those are for things like compliance, payroll, security, the ledger. Or is a good enough answer acceptable? Because deterministic work is where language models are the weakest and where the incumbents are the safest, while probabilistic work is exactly what AI is coming for. Test number 2 is proprietary data. If a customer's data sits inside of a software system, data that customers generated, and they can't take it with them, well, then that proprietary data has a lot of value for the incumbents. The models are commoditizing fast, so unique data is a real difference maker. Test number 3, is the software bolted onto hardware? Because if it is, that's a good thing. If the software is bolted onto it through devices or sensors, terminals or cameras that you can't rip out with a prompt, the physical anchor might be one of the most underrated moats in software right now. And test number 4, which gets a lot of attention and rightfully so, is usage-based versus seat-based pricing. If you charge per seat and AI is shrinking the headcount, it will shrink your revenue. If you charge for usage, like compute, data, transactions, then AI doing more work, especially agentic AI, means you get paid more. Same technology, different outcomes, and I am fully aware that over the past 6 months, many of the names that we're about to talk about have been shifting from seat-based to usage-based. So the 4 buckets that I grouped them in were number 1, the fragile, the companies that I thought would break down when conditions got tough. Number 2, the wild cards, where I looked at these 4 different tests and I genuinely couldn't make a call either way on how this might unfold. Bucket number 3 were the robust, the ones that I believe are going to survive the disorder. They may or may not get stronger for it, but they will survive. And the last bucket was the anti-fragile. That's the top tier, the ones that I feel pretty confident are going to see a lot of business momentum because of agentic AI. So let's go back and see who is in each one of these buckets, starting with the fragile bucket. And it included companies like Asana, Atlassian, Monday.com, HubSpot, and Adobe. These were companies that failed, a bunch of them, in large part because many of them, though not all, were more probabilistic rather than deterministic and were largely seat-based, not usage-based, without any physical hardware bolted onto the software. Now, the wild cards had 4 companies in it: Zoom, Salesforce, Toast, and Duolingo. Think about it. I believe that Salesforce, for instance, or Toast, they do have proprietary data for existing customers. And I don't think those existing customers are going anywhere. But will they be able to get new customers? I don't know. That's a harder call. Or Duolingo. It has tons of proprietary data, but how valuable is that data in making their tool sticky and getting people to pay for it moving forward? That's a question that is yet to be answered. Our robust bucket included ServiceNow, Snowflake, Datadog, Viva, MongoDB, Shopify, and CrowdStrike. Some of these usage-based. Some of them are seat-based, moving to usage-based. Many of them deterministic rather than probabilistic. And the 4th bucket, which was Antifragile, had 3 companies in it: Palantir, Axon, Cloudflare. Definitely all deterministic. some of them bolted onto hardware. Many of them, two of those three, are usage-based. So the framework's on the table. Now the part that you came for, how did each bucket actually perform? We'll go from worst to best, and it looks like the framework that I had worked very, very well. We'll start with the fragile. The average return is up 5%. Now positive, yes, but remember the market's up 13% during that time. So the bucket that I labeled most likely to break did exactly what it was supposed to do. It lost to the market. The framework's first call holds up, although remember, it's only been 6 months. This is a short time frame. We'll check back in 6 months and see whether or not this holds up. The wild cards came in at plus 13%, which matches the market almost exactly. And honestly, that's the right answer for a bucket of stocks that I genuinely couldn't make a call on. And now the durable companies, the robust and anti-fragile companies together average up 60%, 6-0 in 6 months on average. And not only that, but of these 10 companies, only one of them was losing to the market by 1 percentage point. The rest of them blowing away the market. 3 of them have doubled: CrowdStrike, Datadog, and Snowflake. Remember, against an S&P 500 that is up 13%. The stocks that I labeled durable nearly quintupled the market. The stocks that I labeled fragile lost to it. And that right there is the entire thesis of how I invest, playing out with real money over 6 months. It's not about picking the flashiest company. It's about sorting for durability and letting time do the work. Now, if this kind of framework is how you like to think about investing, if it makes the decision-making process easier and more profitable, that's exactly what we do inside of my investing program, Stock Investing Mentor. Now, Stock Investing Mentor has 3 pillars. The first pillar is that you get real-time access to my real-life portfolio. It's 90% of my family's net worth, with an explanation of every move that I make in real time as I make it. Second, you get access to the anti-fragile stock universe, where every stock that I own and follow is ranked by anti-fragility and valuation. Third, you get 1 hour of live weekly training every Thursday at noon Eastern. It is recorded, 24/7 access to a private online investing community. And by the way, starting now, you get access to Stock Simplifier Pro absolutely free. Now, we're coming up on the 2-year anniversary of Stock Investing Mentor, and to celebrate that, I'm actually knocking a little bit more off, usually offering 10% off. However, if you click the top link below, you can get 20% off an annual membership to Stock Investing Mentor, but this deal is only good until the end of August. By the end of August, that will close, so hit that top link in the show notes below. Now, it is worth pointing out that my system wasn't perfect. I'm not going to sit here and pretend that the framework got everything right. Look at Atlassian. I put it in the fragile bucket, and it returned 54%. That's not a small miss. That was a very good performer in the entire group. So what happened? Well, I underestimated how sticky their developer ecosystem was. I also put it in that bucket, and it was very, very attractively priced. And over the short term, that means that it did very well. I don't necessarily think that's what's going to happen over the long term, so I'm keeping it in the bucket where it's in. But if you take the full picture, 5 at fragile, 5% return for the fragile, 13% for the wild cards, and a 60% average return for the durable and anti-fragile companies, that sets the whole story against a market that returned 13%. So, which brings us to the part that I teased at the start, because this framework, it isn't frozen. It's not static. I update it as the businesses prove themselves, and based on what I've seen over the last 6 months, 3 stocks are earning a promotion out of robust and into anti-fragile. The first is Datadog. It was the single best performer in the entire group, but it's not the return that gets it the upgrade. It's why. Datadog hasn't just survived the shift to AI workloads, it's literally feeding on it. More AI infrastructure means more to observe, and that's what Datadog does. It is an observability tool. It's getting stronger as the environment gets more complex, because you've got to be able to monitor all of your digital properties. And that is the definition of anti-fragility. Now, it is a very expensive stock, so it might not have the greatest returns over the short term. But I'm going to be tracking this over 3 to 5 years, and I do believe that it will prove itself to be anti-fragile. The second earning an upgrade to Antifragile is CrowdStrike. It is up 109%. Now, this one's a little bit remarkable because this is a company that had a huge outage a couple of years ago, and it got through to the other side. The customers stayed, the platform kept expanding, and new AI-driven threats, which we saw really come to fruition when Mythos was released, and it had to be held back by both the company and the US government. It shows that there are going to be even more complex cyber attacks moving forward. And that disorder makes it more essential to have CrowdStrike's tools. Now, again, this is an anti-fragile company, but it is also one that is very, very expensively priced. So don't be surprised to see it maybe take a step back over the short term, but over the long term, it definitely earns this designation. And third is Shopify. It's only up 35%, not as much as the others, but I didn't choose Shopify or any of these because of their 6-month track record. It's because what Shopify's become. We have seen that traffic to brand.com names in the age of agentic AI is accelerating far faster than to websites like Amazon and Walmart. And brand.com is housed and run by Shopify. And Shopify is literally widening the take rate for its merchants, and they cannot rip this out. So here's where the anti-fragile bucket stands today. The new top tier: Palantir, Axon, Cloudflare, and now Datadog, CrowdStrike, and Shopify. 6 names that, in my view, don't just endure disorder, they actually compound because of it. Many of these stocks are expensive, and this is why they are expensive. Over the short term, could be very volatile, but over the long term, I think solid investment. So my question to you is, I want to hear from you. Look at your own portfolio. Which software, where do your software stocks land? In which bucket? The fragile, the wild card, the robust, the anti-fragile? Drop it in the comments and tell me if you disagree with my calls, especially Atlassian, because I know some of you are going to have thoughts on that. Until next time, Brian, out.